By late March 2026, the global economy was bracing for an escalation. U.S. and Israeli military forces were actively striking targets inside Iran, pulling the entire Middle East into a direct, large-scale conflict. This wasn't a hypothetical threat to trade. The Strait of Hormuz was functionally closed to maritime traffic, leaving the world's most critical energy supply chain physically trapped inside the Gulf. This chart shows the immediate impact. As supply lines were cut, Brent crude oil spiked by 60%, hitting $116 a barrel. The consensus among energy analysts and central banks was absolute. With the war intensifying, energy prices were expected to climb even higher. In that environment, betting that oil would suddenly drop was a trade that almost no one was willing to take. Then, on the morning of Monday, March 23rd, the market data recorded an anomaly. At exactly 6:49 a.m. Eastern Time, minutes before the regular markets opened, the baseline shifted. This compares average 5-day volume to that single minute. Someone aggressively sold 6,200 futures contracts, a 9-fold spike with no public news. The trade was worth $580 million, a massive leveraged bet that oil prices were about to collapse. In an active war, someone risked $500 million on the assumption that a diplomatic breakthrough was exactly 1 minute away. Exactly 15 minutes later, at 7:05 a.m., President Trump posted to Truth Social. He announced that the U.S. had held productive conversations with Iran and was ordering a pause on strikes against Iranian energy infrastructure. The threat to the region's oil supply vanished from the public forecast instantly. You can see the crash on this chart. Within minutes of the post, oil prices plummeted by as much as 15%, falling back below the $100 mark. The confusion intensified when Iran's parliament speaker later denied that any negotiations had actually taken place, labeling the news a setup for market manipulation. Regardless of the truth behind the talks, the timeline was perfect. The $580 million sell-off happened exactly 15 minutes before the single announcement that would make that trade profitable. To see how that payout worked, you have to look at the mechanics of a futures contract. It allows a trader to lock in the right to sell oil at a specific high price, even if the market crashes later. At 6:49 a.m., our anonymous trader locked in the wartime price of $116 per barrel. After the 7:05 a.m. announcement crashed the market, the trader could buy those contracts back for just $97. The gap between those two numbers is where the profit lives. By locking in the high price and buying back at the low, this single 20-minute window generated over $100 million in pure profit. A Yale University forensic study later isolated these patterns across 200,000 transactions. They found that these anomalous accounts maintained win rates that suggest the traders were acting on material, non-public information. This wasn't just happening in oil. At the same time the oil contracts were sold, $1.5 billion in S&P 500 futures were bought, allowing someone to profit as the stock market surged following the president's post. On prediction platforms like Polymarket, a network of accounts began logging 98% win rates on highly specific military actions, correctly guessing the timing of strikes hours before they occurred. The pattern became so visible that Iran's parliament speaker publicly warned his citizens to treat U.S. policy announcements as reverse indicators designed for profit-taking. It was a bizarre development in modern warfare. A foreign adversary was accurately predicting U.S. market timing by simply pointing out a rigged pattern. These trades triggered immediate scrutiny from the CFTC and the SEC, alongside aggressive denials from the White House that any administration officials were involved. While it is legally difficult to prove the identity of these anonymous accounts, the data shows a 9-fold spike in trading volume that occurred exactly 15 minutes before the public knew the strategy had changed. This suggests a shift in how individuals profit from conflict. Revenue isn't just flowing to defense contractors or energy majors. It is being captured through heavily leveraged bets on Wall Street and prediction platforms. In modern financial warfare, the largest gains go to insiders who occupy the 15-minute gap between a decision and the world finding out.